Hi, and welcome to Investments. This is Chapter 5, Modern Portfolio Concepts, Part 1 of a two-part series. Now, first initial concept is, what is a portfolio? Well, obviously, it's going to be a grouping or collection of investments, hopefully to meet one or more investment goals. So what we're saying here is that we want to put together, and it doesn't have to be all one type of investment. It could be a mix of bonds and stocks. It could be a mix of real estate and other investment properties, but a portfolio is just basically some sort of collection of assets, more than one asset together for a common purpose, like saving for retirement. Many portfolios are growth oriented, so we want to grow our capital in a long-term, hopefully a steady and a long-term process. We want to get the capital gains, which is the price appreciation or the increasing price value of each of the assets in the portfolio. Now, an income-orientated portfolio is going to be one where it's going to produce money for us, cash, dividends, interest payments. So the objective of this portfolio is creating a portfolio you can live off of. So the return of the portfolio is going to be measured not so much in the increased value of the assets. They probably will remain somewhat steady, but we're looking at the money the portfolio throws off. You can have mixed portfolios that are part growth, part income. It really depends on what your goal is. Generally, when you're starting out and you're saving for retirement, you're going to go with a more growth-oriented portfolio full of growth-oriented stocks. And as you become closer to retirement, you're going to slowly shift that portfolio over to more income-generating assets. And then when you fully retire, you may have a portfolio that's just income-producing assets. There are other types of portfolios. There is a movement for FIRE, which is a early retirement movement where they save up a big enough amount of capital, put it all into stocks, and withdraw 4% from this portfolio every year. And the idea is that a stock portfolio should grow faster than 4%. So thereby taking 4%, only 4% out per year, you could live indefinitely on the stock portfolio. So you would really have to calculate how much money would you need per year to live on. So, and then that would be 4% of some sort of portfolio. So if you needed, say, $100,000 per year to live on, you would just take $100,000 and divide by 4%, and you get 2.5 million. So you'd have to save up 2.5 million in a stock account to live indefinitely at a 4% rate. Now, this is making a big assumption that you're not going to face a prolonged bear market. Okay, moving on. So portfolio objectives. So the ultimate goal is to make an efficient portfolio, and that's one that's going to give you the highest amount of return for a given level of risk. So you want to assemble your group of stocks that in such a way that the returns from these stocks is going to be the most amount of money you could make for that risk level. So you don't want underperforming stocks that are risky and tend not to return a lot. You're looking for stocks that are hopefully less risky that return more. So this is going to require searching quite a bit of investments to put together a portfolio that's going to be the best combination of risk and return to create what we would call an efficient portfolio. And basically a portfolio where you're getting the maximum amount of returns you can for the risk level you're taking, say a moderate risk level. What stocks that fall into a moderate risk level will give you the biggest return. So if you had 5,000 stocks to review, there may be 50 out of those 5,000 stocks that are the best to own. But again, there's no guarantee of what you're picking. This is just your goal. You're trying to achieve an efficient portfolio, and you may get close, but it's very difficult to make a perfectly efficient portfolio. Now, when you have a portfolio, it's important to calculate the return of that portfolio. And we could use the weighted average formula shown down here to calculate the return of the portfolio by weighting average each of the assets in the portfolio and the return in the portfolio. So we could kind of look at it. We can look at the formula here. We have historical returns for stock 1 and stock 2, right? So these will be our two stocks. So in this, we represent Walmart and Century Casino. So if we only had two assets in this portfolio, And then we'd have the average return for stock 1 and the average return for stock 2 from year 2008 to 2017. Now, Walmart makes up 80% of the portfolio, and Century Casinos makes up 20%. So we would take the return for 1 year, 19% times 80, plus 20% times 15. And this would give us the portfolio return for that year. Now, we can get the average return by adding up all of the portfolio returns and dividing by the number of years here, which I believe is 10 years, and to get an average return for the portfolio. Okay. So in the previous slide, what it shows us was the returns on the individual stocks in a particular portfolio by each year. Now we want to quantify the risk of those returns over time. So now we can move on to see how risky those returns were. So if we use a standard deviation here, so this is standard deviation for Walmart. So if we calculate the standard deviation for Walmart, we could look at that would be 18.6%. And then the standard deviation, this is over the 10-year period, which is denoted by this 10 years here, permutations of 10. So we run it through the standard deviation, we get 53%. So if we're going to do the portfolio together, then we would actually use the portfolio weights, which is back here. We're looking at these portfolio weights here. Before, we were using these to calculate the standard deviation for Walmart, casinos, and then we can use the portfolio. So in the portfolio, you would see we would take this 19 here, and the 16 here is the average. So that's what we're doing here. It's for each year, 19 minus 16 for the first year until we get to the very end. Follow the standard deviation calculations, and we get this is the portfolio standard deviation. So you can see that the standard deviation for each stock is wildly different. But when you put the stocks together, considering that the standard deviation actually mitigates based on the way the returns are. So it's actually safer to own both stocks in a portfolio than either stock individually, is what that's showing. Okay, so in the spreadsheet, so this is what we would do in a spreadsheet to calculate our standard deviation. So we have our formula down here, and we found the standard deviation of Walmart, standard deviation here of casino, and then standard deviation here of the portfolio. And it's really simple. You just stdev, and then you just highlight the range of returns, and it'll calculate the standard deviation pretty simply in the spreadsheet. And again, I'm going to make a separate video where I set all this up and go through it a little bit more directly in the spreadsheet. Okay, so a portfolio standard deviation is going to depend on three things: the standard deviation of each asset within the portfolio, the weight of each asset, the bigger amount of money that the stock has in the portfolio, the higher percentage weight, the more influence its standard deviation will have in the portfolio. And then the correlation between each assets contained in the portfolio, which means how are they moving in the same direction, opposite direction, in different directions as far as their returns. So that means basically portfolios where when some stocks do very well, other stocks might do not as well, and you're building sort of a more safer portfolio with more predictable returns. And that would be noted by a lower standard deviation, which is a representation of a lower dispersion. Now, when we're talking about the correlation between assets, so let's just talk about the concept of correlation. So it's a statistical measure, which is a relationship of a series of numbers. So you can be positively correlated, negatively, or uncorrelated. So assets moving in the same direction will be positively correlated. Assets moving in opposite directions will be negatively correlated. And assets moving with no relation will be uncorrelated. So think of it like the positively correlated would be two people handcuffed. So if two people are handcuffed together, they would be positively correlated, meaning that they're always moving in the same direction or always in the same place. Negatively correlated would be two magnets that repel each other. So if you ever played with magnets, you know at a certain disposition, the two magnets repel each other. So those would be negatively correlated, where you can't bring them together. They're always moving in opposite directions. And uncorrelated would just be two very random assets that have no mathematical correlation. It's just a complete randomness where they may be, and they don't really the movements of each other are independent. Okay, now what we use is a correlation coefficient. So this is a measure where back here we're just talking about the concept. Here we're actually trying to put a number on it. So we could say a correlation coefficient, two positively correlated assets always moving in the same direction would be a correlation coefficient of 1. Two perfectly negatively correlated assets would have a correlation coefficient of -1. So so kind of think of it like this. If you bought 100 shares of Walmart as one asset and then another 100 shares of Walmart as another asset, those would be two perfectly positively correlated purchases. Whereas if you were to go long on a stock, 100 shares, and then simultaneously go short on a stock, 100 shares, those would be perfectly negatively correlated, meaning that if the stock goes up $10, you make $10 per share in the long position, you lose $10 per share on the short position. So no matter what happens, you're always going to come up with a zero return because your assets are perfectly negatively correlated, meaning they're moving exactly the same in opposite directions. Now, the calculated correlation coefficient, you basically would use the function Correl, and you would highlight the first range of returns, comma, the second range of returns, and you can calculate a correlation coefficient. So you see that these stocks are moving in more opposite direction. So when this stock is going up, this stock is going down. This stock's going down, this stock's going up, this stock's going up, this stock's going down. So you could kind of see that in the numbers where there is some a correlation coefficient here. Okay, these are like a different set of numbers, but you get the point. Okay, so let's look at a graphic of these two. So in this graphic, perfectly positive correlation, you see that when this stock goes up, stock P goes up. When P goes down, M goes down. Perfect symmetry. Here, when one stock's going up, the other stock's going down. And when one stock, M, is going down, N is going up in the perfect symmetry. So these would be that 1 in perfect positive and a -1 in perfect negative correlations. So this correlation helps us bring us closer to diversification. So the lower the correlation between any two asset groups, the greater the reduction in risk. So investors can achieve a combination. They're looking for the combination of assets that would give them a better correlation. So you don't want a correlation too close to 1, and you don't want a correlation too close to -1. So when correlations are say just 1, they're, the average risk of the portfolio is the same. So a correlation of less than 1, the portfolio risk will be less than the average risk of stocks in the portfolio. So basically, if you put think of every stock having a risk of 1, and you put them all in the same portfolio together, they're just in a perfectly positive, they're all going to have the same exact identical risk. They don't benefit each other. But putting some mix of stocks in with different correlations that's going to result in a coefficient of less than 1, greater than 0, then you're going to be able to lower the risks of that stocks in the portfolio. And of course, if you have a negative correlation combination of assets, it's going to produce no risk at all, but as a side result, it's going to produce no benefit. So a -1 would denote no risk, no return. A +1 would denote the most risk and the most return. So if you're looking to mitigate risks, you can build a portfolio where, and the classic portfolio would be a mix of stocks and bonds, which have a correlation less than 1, greater than 0. So that way, if stocks are really doing poorly, bonds typically to do better. And if bonds are doing really poorly, stocks tend to do better. Not always 100% of the case, but that's the idea between that bond stock mix in a portfolio to get that correlation lower, because bonds historically typically move in the opposite direction of stocks. So let's look at a couple of portfolios here. So here's Consolidated Edison, Duke Energy, and a 50-50 portfolio. So these are both energy companies that I believe will say produce electric and sell electric. I'm not 100% sure on that, but I'm mostly sure. Now, you see how they're very, very similar as far as the red, blue, and yellow are moving together in a very similar pattern. So we would say these are pretty close to one correlation. However, if we looked at a short ETF, ProShares short ETF, and a Vanguard S&P 500 ETF, basically this ProShares short is the S&P 500 short, or similar stocks to the S&P 500, maybe not all of them, and this is just the S&P 500 long. In a 50-50 portfolio, we see that when one goes up, the other one's going down in almost perfect symmetry, and the end result is nearly zero return. Another useful calculation, denoted by equation 5.2, is finding the standard deviation of a portfolio. So we could use this equation down here to show the standard deviation of a portfolio, and like we were demonstrating before, and we can make a portfolio that, for sake of simplicity, that just contains two stocks. And then the standard deviation of each stock. So the stocks would be denoted by the weight 1 and 2, and the standard deviation S1 and S2. So in this correlation, we could calculate the standard deviation and the coefficient correlation between the two stocks. So let's look at this a little bit more closely. So we have, again, Walmart and Century Casinos here, and these are the weights. This is a portfolio where it's only Walmart, 0 casinos, and this portfolio down here would be 0 Walmart, 100% casinos, and then we have every iteration in between. So to calculate the standard deviation of each portfolio, so we have the standard, let's see here. So we have the average return of Walmart and the average return of Century City. So we would just take 100% of the Walmart return plus 0% of the casino return, and we get the portfolio average return of 11%. Now, calculating the standard deviation of that portfolio, we would get 18%. So we could do that for every mix, and we could kind of look to see whichever portfolio has the lowest standard deviation, which would have been an 80-20 portfolio. This is the portfolio that would have the least amount of risk in it, because it has the lowest amount of standard deviation. Okay. Now here's an example calculation of the standard deviation for equally weighted portfolio. So this would be a portfolio where we would take this gets a little confusing with the nomenclature down here, but they do break it out in the actual mathematical calculations down here to get that portfolio. So they're showing here that, let's just go back here, equally weighted. So this would be equally weighted here, 50% Walmart, 50% casino, to get the portfolio average return, which is 22.7%, and they calculate a 25.1% standard deviation. So here is where they're showing mathematically how they calculated that 25.1% utilizing this formula. And again, something that I would demonstrate in Excel, not necessarily during the PowerPoint presentation here. So you can look for that video as well to be posted. Okay, here is what we call a frontier. So this is the portfolio standard deviation by the portfolio return. So we see that this is the most efficient point, 80% Walmart, 25% casino, which we calculated previously. So this would be the most efficient point here as far as looking at the portfolio standard deviations versus the return. So we have 100% Walmart and we have 100% casino, and we see that the standard deviations are the highest when it's just 100% casino, but the standard deviation is the lowest when it's 20% Walmart, 80% Walmart, 20% casinos. So this would be the most efficient portfolio of the mix. So that's why we could use these statistical measures to try to put what-if scenarios together, or portfolios, to try to figure out what would be the best combination of the two portfolios. Okay, so here we have three assets, X, Y, and Z, and the assets projected returns for these years, with an average return and a standard deviation already calculated for us. What portfolios could we put together? We could put together two different portfolios from this combination. So our projected portfolio returns for a portfolio that would be X and Y, so just these two stocks. And then a portfolio that would be X and Z, X and a Z. So by using this formula here, 2/3 X plus 1/3 Y, we can calculate the returns of that portfolio. So you see that X and Y in this proportion is going to be that same percentage, because if you look at the returns of X and Y, 2/3 and 1/3, no matter what year, the returns are always going to give the projected returns of 13.3% in this combination of X and Y. And that's just a relationship. It just seems that 2/3 of X plus 1/3 of Y always results in 13.3%. However, if you take 2/3 of X plus 1/3 of Z, you're going to get, of course, in this first equation, since they're both 8% return, you're going to get 8%. But as we move down, the returns for Z are in different proportions, so they start producing a different return. So then if you look at the standard deviation here, you get 0 because there is no standard deviation. The return is equal no matter which year you have, so there is no real difference in your risk here as measured by standard deviation. Now, in your X and Z portfolio, you actually have a 4.2% standard deviation. So there is a little bit more risk in this portfolio, where some years you earn below 13% and some years you earn above 13%. And some years you earn equal 13.3%. So there's a little bit more risk in this portfolio mixing. Okay. So that's the way to look at expected returns and then putting together different portfolios. So mathematically, you might do this with a whole host of different combinations of stocks, maybe utilizing a computer program, putting all the data in and putting these parameters in for it to spit out. This would be the optimal mix of stocks for the expected return, with the lowest, so the highest return with the lowest risk is what you would want to look for using that methodology. Okay, so let's move on to the risk and return for a combination of those two assets, basically what I was just talking about before, with various correlation coefficients. So in figure 5.4, which is this figure here, so we're going to be talking about this figure next, we want to see the illustration of how a low return, low risk asset can be combined with a high return, high risk asset in a portfolio, and how the performance of that portfolio depends on the correlation between those two assets. So here we're looking at combining two very different things. Low return, low risk, with a high return, high risk. But the correlation between the two is going to be important as far as the desired outcome. So when an investor shifts the portfolio weight from a low return to a higher return, the portfolio return, of course, will rise as we're moving more money out of the lower return and into the higher return. And the standard deviation may rise or fall, but depending on the correlation of how the movement of the returns of the assets. So what we want is, the lower the correlation, the greater the risk reduction that can be achieved through this. So we can see this graphically here. So here we have our correlation coefficients, 1 and -1. So if we're looking at this, we're looking at the low return, low risk, and high return, high risk. So over here, we're looking for a frontier that's going to produce the combination of these two assets that would produce the most beneficial percentile mix of the two assets. But this is just a graphic representation of slowly switching out those percentages of those two assets and seeing how overall the portfolio return. So here we see the portfolio return would be if the red line would say if the correlation was a perfect 1. So then we would see a very even upturn between risk and return as we put more of the riskier asset into the portfolio and less of a lower risk asset. So we naturally see an increase in the portfolio return with the increase of the portfolio risk. Now the blue line is if there was zero correlation between the two assets. So here we see sort of a bending of the line denoting more unpredictable mixing of the two. Now if we look at the black line, which would be a negative correlation. So, and here, what we would see here is the portfolio actually decreasing in return and in risk. Okay, so let's move on to international diversification. So in the international diversification, now when we talk about international diversification, the idea is that you can achieve a higher level of diversification, higher return and lower risk by buying stocks from a multitude of different markets and countries to have a more diverse relationship than, say, having all your stocks invested in US-based companies. So now, because different economies can grow and decline at different rates at the same time, it makes sense if you wanted to lower your overall risk and increase your return to have an international diversification. Although this doesn't guarantee an increased return. But the returns in different markets around the world, of course, some markets will be doing very well and other markets will be doing very poorly. But the correlation is definitely going to be greater than 0 and less than 1, which is what we want in a more efficient portfolio. So by buying stocks for companies across the world in different stock markets, rather than just a few, you're going to be able to take advantage of mature economies, emerging market economies, and moderate economies. Now, since the economies of the countries of the world are intermixed and with their commerce with exports and imports through the growth of globalization, there's going to be a rising correlation of the markets where it tends that when there is a recession in a large important market, say Asia, Europe, North America, that sort of bleeds over and affects all the other markets and has a general world direction of growth or decline in markets, which limits some of the diversification potential. But still, you can understand that it makes sense to have more of a global portfolio because you may have some economies that are growing. So you have the Indian and the Chinese economies growing greater than 5%, sometimes close to 10%, and then more mature economies of Europe and North America growing at 2 to 3%. You can see how that mix would be a better overall long-term growth for your portfolio. Now, methods for this international diversification. You can invest directly in companies in foreign countries. And so you would have to use foreign currency exchange. You take your currency, exchange it into the foreign currency to buy those companies in those foreign exchanges, which also opens up the possibility of foreign currency risk, the change of the currency affecting your overall returns. And this is inconvenient, expensive, higher fees to do this. Now, there are plenty of foreign companies that will trade, say, in the New York Stock Exchange. So the New York Stock Exchange includes a number of companies that are from foreign countries. So, a company like Sony or Toyota in Japan trade on the New York Stock Exchange, and they are Japanese companies. So by buying on the New York Stock Exchange, you can buy in dollars, sell them in dollars, and receive your dividends in dollars. So it helps to mitigate some of those costs, and you also have the most favorable commission rates buying them there. Now, you can buy foreign stocks or bonds on U.S. stock exchanges. So Yankee bonds, or bonds issued by the U.S. bond market by a foreign entity. And there's also this American depository shares, something we'll talk more about in a later chapter when we talk about stocks. And these are a way of selling foreign stocks through American exchanges. And you can also easily buy an international mutual fund and let the mutual fund manager deal with buying and selling of the foreign stocks. Now, other methods of international diversification is you could build a company, you could build a portfolio of companies, U.S. companies that have a high exposure to international business. So we'll call them multinational companies that their business is split among many countries around the world. So think of like a McDonald's that has McDonald's restaurants in many countries around the world, or maybe KFC with Kentucky Fried Chicken through Yum Brands has restaurants all over the world. So it's a really international business. And there are plenty of other companies that make, say Intel makes Intel processors for computers that are sold around the world. So you don't really have the full benefits of being a fully international company, but you have a U.S. company which is going to enjoy the benefits of foreign countries' growth because they're traded. And in some cases, you might take a company like Airbus or Boeing, and they're selling to many countries around the world. So truly, if a country is doing very well and they're buying planes, the Airbus or Boeing are going to benefit, and they could be considered a multinational type of corporation. But this is sort of a shortcut to getting that international exposure. Generally, if you really want a true international exposure, you would have to buy companies in the foreign exchange, in a foreign land. Now, as far as diversification, the cost of the international diversification is more expensive. So most stock advisors would say have at least 20 to 30% of your investments from international companies. Now, you would want to take this 20 or 30% and put it in a mix between established, mature foreign markets and also emerging markets. So you could think of sort of like Brazil, India as emerging markets. You can argue, are they emerging markets or moderate markets or established? But you're looking to have a mix of different economic progress in different countries. So emerging markets tend to grow faster than established markets. So that's why we want to have this mix between the two. Now, the transaction costs of buying and selling these securities directly tends to be, like I was saying before, more expensive because you get hit with international trading commissions. You could also be hit with currency cost by having to translate your domestic money into foreign currency. Usually you're going to get it at a rate that's not as the most favorable rate. So that's why international mutual funds or American depository shares, which are foreign shares trading on the American exchanges, will allow you to obtain this international diversification at a much lower cost, a more convenient and more liquid cost. And then the U.S., everything would be in U.S. dollar and the protection of U.S. security laws as well. So foreign firms can't list on the New York Stock Exchange unless they meet the SEC regulations and transaction laws. So it does protect you a little bit more about how these would be established the companies have to establish and produce financial reports and statements in conjunction with the SEC rulings of these American exchanges. Okay, so that's the end of part 1. Part 2 we'll pick up and we'll start talking about the capital asset pricing model. I look forward to talking to you then. Take care.